Welcome back to Aero Talks. We are jumping right into, well, the sudden and pretty dramatic grounding of Eastern Airways, a key British regional carrier. They announced financial insolvency back on October 27th, 2025. So the deep dive isn't just, picking over the bones of an airline failure. It's really an urgent look at how tight these regional connectivity margins are and how they're being, frankly, shredded by rising costs and, well, weak domestic demand. It leaves a real hole, doesn't it?
Oh, absolutely. A tangible hole in the UK transport structure. And the immediate fallout is, well, significant. All flights are suspended straight away. And the UK Civil Aviation Authority, the CAA, they've put out a stark warning. Basically, if you have future bookings, don't go to the airport.
Right. Just stay home.
Exactly. Now, legally, what they've done is file a notice of intention to appoint an administrator. Sounds formal, and it is. It gives them a short window, about 10 business days, yeah. Protection from creditors?
Okay, so a bit of breathing room to find a buyer or financing?
Ostensibly, yes. That's the idea. But, and this is the fascinating bit, they'd already quietly returned most of their aircraft to the lessors before this filing.
Ah.
Yeah, that action. That's the real insight here. The notice feels more like a formality. Returning the assets, well, that signals management had likely already decided. Liquidation, not rescue.
That is a powerful signal. So was this coming for a while? I mean, let's unpack the numbers that pushed them over the edge. They moved, 1.3 million passengers a year? That sounds like a lot.
It does, but the financial reality behind it was, well, brutal. For the fiscal year ending March 2024, they posted a massive 19.7 million net loss. Nearly 20 million quid.
Wow.
And total liabilities, their total debt nearing 26 million pounds.
So with numbers like that, was the pandemic the main cause or just the thing that finally tipped it over?
I think it looks much more like the final straw. The one that broke an already heavily burdened camel's back. That 19.7 million loss, if you break it down, it means they were burning through roughly 54,000 pounds every single day.
54,000 a day just to keep flying.
Just to keep the planes in the air, yeah. And if you connect this to the bigger picture, the struggle was layered. They started up back in 1997, initially doing well with specialized industrial routes, like Humberside to Aberdeen for the oil workers.
Right, niche markets.
Exactly. But they really struggled against the low-cost carriers moving in on their other routes, the leisure ones. Then you got the triple shock post-COVID, volatile fuel prices, crew shortages, driving up labor costs, and just an inability to pass those higher costs onto passengers who were already dealing with inflation themselves.
And management specifically blamed that combo, didn't they? Rising costs and weak demand on key domestic routes.
Yeah.
So it wasn't really a sudden collapse, more like a slow managed wind down, especially since they stopped selling tickets even before the formal filing.
Precisely. It signals they saw it coming and tried to manage the end. The money ran out, yes, but what's the real cost beyond the balance sheet, the human cost?
Yeah, exactly. What's the impact on people and regions?
Well, this gets to a really important question about what regional air services are actually for. Eastern wasn't just flying profitable routes. They operated crucial services, some under what are called public service obligation contracts, PSOs.
PSOs. Those are the government-backed ones, right?
Yeah.
To keep essential links open.
That's right. Designed to protect connectivity for communities that might otherwise be cut off or face really long journeys.
And this is where the hole they leave behind feels deepest. For travelers, for industry, like you mentioned the Aberdeen Wick service.
Yeah.
That was vital for the North Sea oil and gas sector, wasn't it? That just gone.
Severed, exactly. Or think about the Gatwick to Newquay route, a fast 1-hour flight link to Cornwall.
Yeah, avoiding what, a 7-hour train ride minimum.
Minimum 7 hours on the train, yeah. Losing that flight fundamentally changes access for tourism, for business.
So the loss really hits hard in specific places.
It really does, and it shows us just how financially vulnerable these essential links are. The insight here, I think, is that the government subsidies in those PSO contracts, they just didn't keep pace.
Not enough to cover the rising costs.
Apparently not. The fixed subsidy rates couldn't absorb the simultaneous spikes in jet fuel and, crucially, the salaries for specialized regional pilots hitting the market over the last year or so. So, paradoxically, the routes that are most critical for regional stability are also the most financially precarious when the global cost structure shifts like this.
It's a real tight spot then. So, unless some investor magically appears in the next few days during this protection window, that's basically it. 28 years of operation, over.
It seems highly likely, yes. Barring a last-minute rescue, their time as an independent carrier looks finished.
Hmm.
And that really forces us, and maybe you listening, to chew on a final thought. In an era where domestic travel costs just keep going up, how can governments reliably ensure these small, vital carriers survive? Especially when they provide critical, often non-profitable links for key industries and remote communities. Is it just about more public money or anything else?
A tough question with no easy answers. Thank you for listening. We will see you in the next episode.